Hey everyone, Longacres Finance here with 5 important things you should know about your 401k plan and saving for retirement. Number 1, you want to start saving as early as you can because time is your best friend when it comes to investing. Warren Buffett, one of the best investors of his time, once said, "The best time to invest was yesterday. But since the time machine hasn't been invented yet, yesterday isn't an option. The next best time is today or tomorrow or as soon as you can. The longer you wait to start, the more it could hurt you in the end. The first money you contribute to your 401k is the most important because it will have the most time to grow and compound." If you have never heard of compounding, it is simply the process of earning interest on interest, or when it comes to investing, earning gains on gains. To understand compounding better, here's a quick example. If you start with $100 and earn a 10% return in year 1, your investment is now worth $110, meaning that your account gained $10. If in year 2 you also earn a 10% return, now your investment is worth $121, meaning that your account gained $11. Even though in both years you earned a 10% return, your gain in year 2 was $1 more than in year 1. That's the compounding effect, and over a long enough time period, its effects can be exponential. Here's another example to show you the difference between starting to save early or later in life, and how time and compounding really make a difference. Let's suppose you want to retire at age 67, and you achieve a 7% annualized rate of return, and your goal is to end up with $1 million in retirement. If you start saving at age 22, you would need to contribute about $254 per month, or about $59 per week. If you start at age 30, you would need to contribute about $449 per month, or $104 per week. That's 77% more compared to starting at age 22. If you start at age 40, you would need to contribute about $955 per month, or about $220 per week. That's 276% times more compared to starting at age 22. If you start at age 50, you would need to contribute about $2,230 per month, or $515 per week. That's 778% more compared to starting at age 22. If you wait till you're 60, you would need to contribute about $6,958 per month, or $1,606 per week. That's 2,639% more compared to starting at age 22. Another important factor of having more time is that you have more flexibility to take more risk with your investments, and that may greatly increase your return over time. The stock market has a 10% correction on average about every 2 years, and a 20% correction about every 6 years. Therefore, the less time you have till retirement, the higher the chance that a correction will negatively impact your overall return. Number 2, you want to max out your contribution each year, or aim to contribute as much as you can. For the year 2020, the 401k contribution limit is $19,500, and if you are 50 years old or older, you can contribute another $6,500 in catch-up contributions. For those of you that don't have access to a 401k retirement account, don't worry. As long as you have taxable income, you can open an IRA, which is an individual retirement account, and that is very similar to a 401k. An IRA isn't linked to your employer, and therefore you have the option to choose any brokerage you desire. Vanguard is one of the most popular options, and it doesn't cost anything to open an IRA with them. There are 3 types of IRAs. A traditional IRA gives you tax savings right now, a Roth IRA gives you tax savings in the future, and a SEP IRA is for people that are self-employed. With a traditional IRA, you contribute after-tax dollars and paid taxes when you withdraw the money in retirement. Whereas in a Roth IRA, you contribute pre-tax dollars and don't pay any taxes when you withdraw the money in retirement. The biggest factor you want to consider when deciding between these 2 options is whether you expect to be in a higher tax bracket today or in retirement. If you expect to pay higher taxes today, a traditional IRA may be the best option for you. And if you expect to pay higher taxes in retirement, a Roth IRA may be the best option for you. And if you can't decide, you can always contribute to both and save a little on taxes today and in retirement. The IRA contribution limit for the year 2020 is $6,000 with an additional $1,000 in catch-up contributions for those 50 and older. Keep in mind that the limit is on your overall contributions, regardless of which option you choose. Number 3, choosing the right asset allocation for you, and the keyword here is you. You should take into consideration your current age and the number of years before you would like to retire. The other thing to consider is your risk tolerance. A good question to ask yourself is, what would I do if the market suddenly dropped 50%? Would I stress out about the decrease in value of my account? Would I consider selling my investments to prevent further loss? Or would you be comfortable waiting a year or 2 for the market to rebound? If you think you would be troubled by such a large loss, you probably should not take too much risk with your asset allocation. On the other hand, if you're willing to wait out bad market times to possibly increase your overall return, then maybe you can take a little bit more risk. Let's take a step back and begin with the easiest approach to an asset allocation. Target date funds are a wonderful product for a hands-off approach. They simply require you to estimate the year you would like to retire. For example, we are in the year 2020, and let's say you are 45 years old and expect to retire when you will be 67 years old. That is 22 years from today, so somewhere around the year 2042. In this case, you would select either the 2040 or 2045 target date fund, depending on if you would rather be a little conservative or take on a little bit more risk. Target date funds are set every 5 years, so there is no 2042 option in case you were wondering. The chart on the right is what a target date fund offered by Vanguard looks like. The horizontal axis shows years before and after retirement, and your retirement is identified by the white vertical line. The vertical axis is your asset allocation as a percentage. If you choose a target retirement fund that is 40 years out into the future, since it's 2020 today, that would mean a 2060 target date fund, your allocation would be equivalent to the leftmost part of the chart. As you near retirement, the fund automatically reduces your exposure to riskier assets and increases your exposure to less risky assets. The red shaded area are US stocks, which tend to achieve higher returns but carry higher risks. As you move across the chart from left to right, you can see that a significant portion of your investment is allocated to US stocks early on, and as you get to about 25 years till retirement, it begins to decrease. The yellow shaded area are international stocks. Historically, they have also achieved good returns, but on average not better than US stocks, and they also carry a higher risk. Owning international stocks provides a level of diversification during times when the US economy is slowing, while certain international economies see higher growth. As you move across the chart from left to right, the allocation to international stocks begins to decrease about 25 years prior to retirement and becomes quite small during retirement. The dark blue shaded area are US nominal bonds. A nominal bond is a bond which makes payments of a fixed amount, rather than a fixed real value that is inflation adjusted. Bonds historically have smaller returns than stocks, but carry less risk. As you move across the chart from left to right, you can see that you begin with a rather small allocation of US nominal bonds that starts to increase about 25 years before retirement and becomes the largest part of your portfolio in retirement. The blue shaded area are international nominal bonds, and they too have provided smaller returns compared to stocks, but with less risk. However, they are more risky than US nominal bonds and can carry currency rate risks unless they are held in a US dollar hedged fund. As you move across the chart from left to right, you can see that you begin with a tiny allocation to international nominal bonds that begins to increase about 25 years before retirement and ends up being about 15 to 20% of your allocation in retirement. The light blue shaded area are short-term TIPS, and TIPS stand for Treasury Inflation Protected Securities, which are as safe of an investment as you can make next to having your money sitting as cash. They don't offer great returns, but they will return more than owning cash itself. As you can see in the chart, they don't actually become part of your portfolio until about 5 years before retirement, but increase to about 20% of your allocation in retirement. The allocation on the far left side of the chart should achieve the highest return, but also carry the highest risk, while the allocation on the far right should achieve an average return and carry far less risk. Vanguard has one of the simplest target date funds to understand because it's only made up of 5 components. Other brokerage firms can have target date funds with up to 20 components, but just because they have more moving parts does not mean they are better. When selecting between different target date funds, you want to compare historical performance and costs. Target date funds come with a premium cost for a hands-off approach. If you opted to follow the same strategy but select and modify your own allocation over time, you could possibly save about 50 to 75% depending on the cost of the funds in your plan. There are also a few other popular asset classes not included in Vanguard's target date fund. Those are emerging market equities and bonds, global listed infrastructure, REITs, which are real estate investment trusts, precious metals, corporate bonds, high yield bonds. They can offer more diversification and possibly higher returns, but they also come with risks. If you decide to set your own asset allocation, you can do more research on these asset classes and see if they would be a good fit in your portfolio. Number 4, expense ratios. That is how all funds state their fees. You can find a fund's expense ratio in their prospectus or annual report. The fees get taken out of the market price or NAV price, which is a net asset value, at the end of the day, and it will be fractions of pennies on a daily basis, so you will never actually see what the amount is. It's an efficient yet clever way for funds to not directly show you how much your investments are costing you. In a 401k plan, you can also have something called a remuneration fee. That is a fee tacked on by your employer, either onto individual funds or your entire portfolio, to help offset the cost of offering a 401k plan. These can also be hidden if they are tacked on to fund fees. One way to tell if a fund has added remuneration fees is to compare the expense ratio of the fund from a report within your 401k plan to a report you can find on the web. If the two costs are the same, then most likely the fund does not have a remuneration fee. However, if they are different, the difference is usually the remuneration fee. If your plan has remuneration fees, don't worry too much about it. It's possible your employer wouldn't be able to offer a 401k plan without them. 401k plans can be a big financial burden on smaller employers. Back to expense ratios. They are stated using basis points. 1 basis point is equivalent to 0.01%, or 100 basis points is equivalent to 1%. For example, if you have $10,000 invested in a fund that costs 10 basis points, it'll cost you $10 per year. If that fund costs 25 basis points, you'd pay $25. That's more, but still relatively not a big difference. Well, consider multiplying that difference times 30 to 40 years, and you will most likely have substantially more money in your 401k over that period of time. On a $1 million balance, that would mean paying $1,000 versus $2,500 per year. You want to aim to choose funds with low expense ratios, but keep in mind that sometimes it's worth paying more for a fund that will offer higher returns. Make sure when you're comparing expense ratios, you're doing an apples-to-apples comparison. A good approach would be to find the industry average expense ratio and aim to not pay more than that average. Number 5. IRAs and rolling over your old 401k accounts. We talked briefly about IRAs in number 2, and I'll throw some additional knowledge at you about them here as well. If your 401k doesn't offer the types of investments you're interested in, or if those investments have high fees, you can consider only contributing enough to your 401k to maximize your employer match and putting the rest of your money into an IRA. When you change employers, you have a few options as to what you can do with your old 401k account. You can either possibly leave it where it is, or you can move it to your new employer's plan, or you can move it to an IRA of your choosing. To make this decision, you want to consider the quality and the cost of your old 401k plan, your new 401k plan, and an IRA. The process of moving your old 401k plan into a new one or an IRA is called a rollover. You begin this process with the plan you intend to move the funds into. They may have an option online for you to download the necessary form that needs to be sent to your old plan instructing them to transfer the funds. If there is no option online, you will need to call your new plan provider to initiate the process and send you the necessary forms. Sometimes you will need to call the provider of your old plan for instructions on where to send the forms. And in certain cases, the check may be mailed to you directly, and you will need to mail that check to your new plan provider yourself. This all depends on the providers. It can be a tedious process, but if your new 401k plan is significantly better, or an IRA is significantly better than your old plan, it can lead to you having more money in retirement, so it may be well worth it. That's it. I hope you learned something from this video. And if you liked this video, please consider subscribing and hitting the like button to support me in making more videos. If you have any questions, please leave a comment below and I'll do my best to try to answer them. Thanks for watching.